Tonight, imagine opening your investment app and seeing silver climbing again, while every financial headline argues about bubbles and overbought charts. Maybe you feel excited for a second because rising prices usually mean opportunity. But something about the conversation still feels strangely incomplete. I remember having that exact moment recently, staring at the chart and realizing everyone kept debating price while ignoring something far bigger. Because the real issue in the silver market right now isn't whether the price went up too fast or might pull back tomorrow. The deeper issue is the structure of the market itself. And once you see it clearly, the entire conversation changes instantly. Before we dive into that, if you enjoy clear explanations about markets, economics, and personal finance, consider supporting the channel today. A quick like helps the video reach more people trying to understand markets, and your comments always push these conversations deeper. And if you want more breakdowns like this about money, commodities, and long-term investing, subscribe so you never miss future episodes. I spend a lot of time studying how markets actually function beneath headlines, and my goal is explaining those mechanics simply. Because once you understand the structure underneath a market, price movements start making far more sense than charts alone suggest. Now let me ask you something simple. What do most people believe drives the price of silver in the first place? Usually the answers sound familiar. Inflation fears, central bank policy, interest rates, the strength of the dollar, maybe geopolitical uncertainty. Those factors do influence precious metals sometimes, but they are not the most important force shaping silver today. In fact, the biggest change happening in the silver market has very little to do with traditional precious metal narratives. Silver is quietly transforming from a simple store of value into one of the most important industrial materials in modern technology. And that shift changes how supply, demand, and pricing behave in ways most investors still do not fully understand. According to the latest Silver Institute World Silver Survey, global silver demand recently reached roughly 1.21 billion ounces annually. At the same time, global mine production sits near 830 million ounces, leaving a significant gap between supply and demand. That gap, about 200 million ounces, represents metal the world uses every year that mines simply are not producing. And once you understand why that deficit exists and why it keeps growing, the real story behind silver begins unfolding. Get speed. Most investors see rising prices and assume silver is becoming expensive. But the deeper reality is that demand is accelerating faster than supply. To understand why this matters, we need to step back and look at how silver actually functions inside the modern global economy. For decades, silver was treated mostly as a precious metal, something investors bought during inflation scares or economic uncertainty. But quietly, over the last 20 years, silver has become something far more critical to everyday technology and global infrastructure. Today, silver is essential in electronics, medical equipment, renewable energy systems, advanced batteries, and high-performance electrical components. The reason is simple. Silver conducts electricity better than any other metal on Earth, even better than copper. That property makes silver extremely valuable in technologies where efficiency and reliability matter more than material cost. Solar panels are one of the most important examples of this technological dependency on silver. Inside each photovoltaic solar cell, silver paste carries electrical current generated from sunlight into usable power for homes and businesses. According to the International Energy Agency, solar manufacturing currently consumes roughly 200 million ounces of silver every year. To put that number into perspective, that single industry already uses nearly 1/4 of the entire global silver supply. And the demand is still growing rapidly as countries accelerate renewable energy investments to meet climate and energy goals. The International Energy Agency projects solar installations could more than double by the end of this decade. If that projection holds, solar manufacturing alone could require close to 450 million ounces of silver annually. That would represent more than half of today's total global silver production going into a single industrial sector. And unlike many other raw materials, replacing silver inside solar panels is extremely difficult without reducing efficiency significantly. Engineers have experimented with alternatives like copper, but copper simply cannot match silver's electrical conductivity in compact designs. When manufacturers reduce silver content too aggressively, panel efficiency drops and energy output declines across large installations. For companies competing in a rapidly growing energy market, losing efficiency can mean losing contracts worth millions of dollars. So most solar manufacturers continue purchasing silver regardless of price, because the cost of inefficiency is even higher. Solar demand alone would already pressure the silver market, but it is only one piece of a much larger industrial puzzle. Another rapidly growing source of demand comes from electric vehicles and the electronics that power modern transportation systems. Electric vehicles require silver in battery management systems, high voltage connections, sensors, and advanced onboard electronics. According to the United States Geological Survey, an electric vehicle typically contains between 25 and 50 grams of silver. That may not sound like much at first, but multiply it across millions of vehicles and the numbers grow quickly. Global electric vehicle production recently passed 14 million units annually, and most forecasts expect that number to keep climbing. Even using conservative estimates, electric vehicles alone are now responsible for tens of millions of ounces of annual silver demand. And unlike discretionary luxury goods, these industrial uses are tied directly to long-term infrastructure and manufacturing cycles. Companies building energy grids, vehicles, and communication networks cannot simply pause production because metal prices increase. They have supply contracts, factory schedules, and billions of dollars invested in equipment designed around specific materials. This creates what economists call inelastic demand, meaning consumption changes very little even when prices move significantly higher. In simple terms, many industries must keep buying silver regardless of price because their products cannot function without it. Medical technology provides another example of this dependency that many investors rarely think about. Silver has powerful antimicrobial properties, which means it naturally kills bacteria and helps prevent infections. Hospitals use silver coatings in surgical tools, wound dressings, catheters, and other equipment where sanitation is critical. Electronics manufacturing also relies heavily on silver because modern devices require highly conductive connections in very small spaces. Smartphones, computers, satellites, and data centers all depend on silver-based components operating quietly behind the scenes. The average person may never see those components directly, but they exist inside almost every advanced technology product. When you add solar panels, electric vehicles, electronics, and medical equipment together, the demand picture becomes far clearer. Silver is no longer just a precious metal investors buy during uncertainty. It has become a core material of modern industry. Once you understand how essential silver has become across modern industries, the next question naturally appears: can supply actually keep up? Many people assume higher prices automatically encourage miners to produce more metal, balancing the market over time. In reality, the mining industry operates on timelines far longer and more complicated than most investors imagine. Discovering a viable silver deposit is only the very first step in a process that can take many years. After discovery, companies must conduct geological studies, environmental reviews, infrastructure planning, and financing before construction even begins. According to research from S&P Global Market Intelligence, the average time from discovery to production can exceed 10 years. That means new mines cannot quickly respond to rising demand in the way many commodity markets theoretically suggest. Even if prices doubled tomorrow, new silver production would still take nearly a decade to meaningfully increase. There is another complication most investors never realize when discussing silver mining. The majority of silver mined worldwide does not actually come from primary silver mines. Instead, it appears as a byproduct during the extraction of other metals like copper, lead, and zinc. That means silver supply often depends on the economics of entirely different metal markets. If copper mining slows because of weak copper prices, silver production can fall even if silver demand is strong. In other words, the silver market cannot easily control its own supply growth. This structural limitation is one reason the global market has experienced several consecutive years of supply deficits. When industrial demand rises quickly, but supply responds slowly, the imbalance quietly grows larger over time. Investors often focus on short-term price fluctuations without realizing the deeper structural forces underneath the chart. Markets rarely react immediately to supply imbalances because inventory buffers can temporarily hide the problem. But eventually, those buffers shrink, and the underlying deficit begins influencing price behavior much more dramatically. That slow tightening process is exactly what many analysts believe has been developing in the silver market. When inventories begin shrinking, another layer of the silver market becomes extremely important, and that layer is the futures market. Futures contracts allow traders and institutions to buy or sell silver on paper without immediately exchanging physical metal. On major exchanges like COMEX, one standard silver futures contract represents 5,000 ounces of metal. That means a trader can control a large amount of silver exposure without owning the physical metal directly. Futures markets are useful because they allow manufacturers and miners to hedge price risk months in advance. For example, a solar manufacturer might lock in silver prices today for metal they expect to purchase later. At the same time, mining companies may sell futures contracts to guarantee a stable price for their production. In normal conditions, this system works smoothly because physical supply and financial contracts stay roughly balanced. But problems can appear when the number of paper contracts grows much larger than available physical inventories. To understand this imbalance, imagine a theater with 2,000 seats selling 10,000 tickets for one concert. As long as most ticket holders never show up, the system appears perfectly stable on the surface. But if too many people arrive expecting a real seat, the shortage suddenly becomes impossible to ignore. The same principle can apply in commodity markets where financial contracts exceed easily deliverable physical supply. If a large number of participants suddenly demand actual metal delivery, the system experiences stress very quickly. Historically, this rarely becomes a crisis because traders usually close contracts before physical delivery is required. However, tight physical markets increase the risk that more participants want real metal instead of financial settlement. When that happens, price volatility often increases because buyers compete for limited physical inventory. Traders watching only technical indicators might not realize these deeper supply pressures building underneath the market. But institutions closely monitor inventory levels because they reveal how tight physical supply actually becomes. And when inventories decline while industrial demand keeps rising, the market structure begins shifting in subtle ways. One signal analysts watch carefully is the level of registered silver inventories available for delivery inside major commodity exchanges. These inventories represent metal that can actually be delivered if futures contracts require physical settlement at expiration. When registered inventories fall, while open futures positions remain high, the potential stress inside the system increases. It does not guarantee a crisis, but it tells analysts the margin for supply flexibility is becoming smaller. Think of it like a reservoir slowly draining, while a city continues using water at the same pace. For a long time, everything appears normal because the system still functions day after day. But eventually, the declining water level forces the city to recognize a structural supply constraint. In commodity markets, that recognition often happens through price adjustments rather than policy announcements. Prices rise until new supply becomes profitable, or demand begins slowing because costs become too high. However, silver presents a unique challenge because several industries cannot easily reduce consumption when prices increase. Solar manufacturers cannot simply remove silver from photovoltaic cells without sacrificing electrical efficiency. Electric vehicle engineers cannot redesign entire electrical systems every time metal prices fluctuate. Medical technologies relying on antimicrobial silver coatings cannot easily substitute another material with identical properties. These realities create a situation where large parts of industrial demand remain relatively stable even during price increases. That dynamic explains why analysts describe modern silver demand as increasingly structural rather than purely cyclical. Structural demand means consumption comes from essential industries rather than temporary investment trends. When essential industries require a material, Purchasing decisions become tied to production schedules instead of speculation. Factories must continue operating even if raw material prices fluctuate significantly over time. This is one reason commodity markets can sometimes experience sudden repricing events after long quiet periods. Once supply constraints meet inflexible demand, the adjustment mechanism left inside the market is often price itself. Now this is the moment where many investors start asking the most obvious question. If supply is tight, why has the market not already exploded higher? The answer is that markets rarely move in straight lines because multiple forces constantly push prices in different directions. Investment sentiment, currency strength, interest rates, and macroeconomic fears all interact with commodity fundamentals simultaneously. Sometimes those financial forces temporarily hide underlying structural shortages developing quietly in the background. Investors may focus on short-term technical signals, while ignoring slower industrial demand trends building year after year. That disconnect between perception and reality can persist longer than most people expect. I have seen many markets where the structural story was clear long before the price reflected it. Oil experienced this before major supply shocks, and several industrial metals have followed similar patterns historically. Markets often ignore slow structural pressure until a catalyst forces participants to suddenly reevaluate supply assumptions. When that reevaluation happens, price adjustments can occur much faster than the gradual buildup that preceded them. But understanding this dynamic does not mean predicting exact prices or timing specific market moves. Instead, it helps investors recognize when a market may behave differently than simple technical analysis suggests. Many traders rely entirely on chart indicators like moving averages or momentum oscillators to guide decisions. Those tools can be useful in liquid stable markets where supply and demand change slowly. But in commodities driven by physical shortages, structural forces sometimes override purely technical signals. When industries require a material regardless of price, the relationship between price and demand becomes unusual. Price increases that would normally reduce consumption may not affect essential industrial demand very much. This is why analysts increasingly describe silver as a hybrid market, combining precious metal psychology with industrial necessity. Precious metals attract investors seeking protection during uncertain economic periods. Industrial metals move according to manufacturing demand, infrastructure spending, and technological development across the global economy. Silver now sits at the intersection of those two worlds, where financial sentiment and industrial necessity interact inside the same market. That combination can create price behavior that sometimes confuses investors expecting silver to behave like gold alone. Gold demand is driven primarily by investment flows and central bank reserves rather than industrial consumption. Silver, however, must simultaneously satisfy investors seeking protection and manufacturers requiring physical metal for production. When both groups begin competing for the same supply, market dynamics can shift very quickly. Bartering. Industrial buyers cannot wait indefinitely because factories depend on raw materials arriving on predictable schedules. Investors also move rapidly when they sense structural opportunities emerging in commodity markets. When those two forces align during periods of limited supply, price volatility can increase dramatically. This does not mean prices rise every day, but it means the market becomes more sensitive to demand changes. Small disruptions in supply or sudden increases in industrial demand can move prices more than expected. Curry. From my perspective studying commodities, these structural shifts are far more important than daily chart fluctuations. Charts show us what happened yesterday, but supply chains explain what might influence markets over years. When investors combine both perspectives, technical patterns, and structural fundamentals, the picture becomes far clearer. Right now, silver sits in a position where structural demand appears stronger than most people realize. At the same time, supply growth remains slow because new mines require many years of development. That imbalance does not guarantee dramatic price movements tomorrow, but it changes the long-term risk profile. Markets facing persistent supply deficits tend to experience tighter inventories and occasional bursts of volatility. Understanding those structural pressures helps investors remain calm when headlines exaggerate short-term market noise. It also reminds us that commodities follow real-world supply chains rather than purely financial speculation. And when we look carefully at those supply chains, the silver market reveals a deeper story still unfolding. Cuarti. When I step back and look at the entire picture, the most striking realization is how quietly this structural shift developed. For years, silver deficits appeared in industry reports, while most investors focused on short-term price swings. Those reports from organizations like the Silver Institute documented supply gaps building year after year. At the same time, global technology industries expanded their dependence on highly conductive materials like silver. Solar panels multiplied across rooftops and utility-scale installations, while electric vehicles entered mainstream production worldwide. None of these trends happened overnight, which is exactly why they escaped the attention of many casual investors. Markets often move dramatically only after long periods when structural changes quietly accumulate beneath the surface. By the time headlines begin discussing shortages, the underlying dynamics have usually been building for years already. That is why understanding the mechanics of supply and demand matters far more than reacting to daily price commentary. Investors who study structure rather than noise tend to recognize important trends earlier and with greater clarity. The silver market today reflects a fascinating intersection of technology growth, industrial demand, and constrained supply expansion. Whether prices rise slowly or move suddenly, those forces will likely shape the market over the coming decade. My goal in sharing this analysis is not predicting exact prices, but helping you see the deeper mechanics involved. Because once you understand how a market actually functions, price movements become easier to interpret rationally. Instead of reacting emotionally to volatility, you begin evaluating the structural forces behind each major shift. That mindset can make an enormous difference for anyone trying to invest intelligently in commodity markets. Silver may continue surprising investors precisely because its role in the modern economy keeps expanding quietly. And as technology evolves, the demand for highly conductive materials could become even more important globally. So the biggest problem in the silver market was never simply price, it was the deeper structural imbalance beneath it. And once you recognize that imbalance clearly, the entire conversation about silver begins to look very different. So if you are watching this video tonight and quietly wondering whether your financial situation can actually improve, I want you to remember that almost every financially stable person once stood exactly where you might be standing today. They looked at small amounts of money and questioned whether saving those numbers could realistically change anything meaningful. The difference is that eventually they made a small decision to start anyway, even when progress felt slow. Maybe that decision was saving $20 from a paycheck or canceling a subscription they barely used. Those actions looked insignificant in the moment, but over time they created habits that slowly reshaped financial behavior. 5 years from now, you will still be 5 years older regardless of what decisions you make today. The only real question is whether those years will quietly build financial stability or repeat the same cycle again. If this conversation helped you see money differently, share your thoughts below and let me know your first small win. And if you want more simple explanations about personal finance, consider subscribing so we can keep learning together.